Hello everyone. I'm glad you're back for our next video in the educational series. This video is the sixth video and it's titled Moving Averages. So hopefully we can learn a little bit about what they are and how we can use them to be better traders. Before we get started, I would like to say that futures and options trading have potentially substantial rewards, but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in the futures and options markets. Don't trade with money you can't afford to lose. This group is neither a solicitation nor an offer to buy or sell futures, options, or other financial products. No representation is being made that any account will or is likely to achieve profits or losses like those discussed in any material within this group. The past performance of any trading system or methodology is not necessarily indicative of future results. So now that we got that out of the way, we can move on and learn a little bit. So what is a moving average? Okay. Moving averages are very common and simple forms of technical analysis. They take the price data from whatever length of time the trader designates and constantly averages the price over the rolling period. There's different forms of moving averages, which are the simple, exponential, weighted, and etc. The ones that we will focus on here at Tactical Trading Services are the simple and exponential moving averages. The mathematical calculations are different for each of them. And there are certain time periods that are more common than others. The most common time periods for the simple moving average, in my opinion, are the 10, 20, 50, and 200. The most common time periods for the exponential moving average that I like to use are the 8, 13, 21, and potentially the 55, depending on what time frame I'm on. The most common application for moving averages, I would say, are to identify the trend. And if we think about it, it kind of makes sense, right? If we have a 50-period simple moving average that is trending in the upward direction, then what does that tell us? It tells us that the average of the last 50 rolling periods on your chart are increasing, which means that the price is going up. It shows you that the current trend is up. Moving averages really help to cut down the noise that is presented to a trader on a price chart. And a lot of times traders, they'll get caught up in little price fluctuations here and there and allow it to affect their trades. But by utilizing moving averages, it will give you a baseline to use in determining trend changes and whether to enter or exit trades. And we'll go over some examples of that. And one thing I would like to note as well is that a moving average is also a very good determining factor to see where support or resistance is at. Okay. Now you can see here the mathematical formulas for the simple moving average and the exponential moving average. I'm not going to give you a mathematics class. You can read this for yourself, and maybe, I just wanted this on here so you can kind of see on the background of how these things calculate their current value. I think that it's important if you're going to use something that you want to know how it's built, right? You want to know what makes it tick. You want to know where you're getting your information from. So you can look back at this on your own free time and pause the video and try to understand. But there's information for you there. So right here on this slide we have a 30-day 1-hour chart of the S&P 500. Okay, and the light blue dotted line, which I'm tracing out with my little laser pointer right there, okay, that is your 20 simple moving average. The dark blue dashed line right here is going to be your 50 simple moving average, and the solid red line is going to be your 200 simple moving average. So let's look over the price action as it relates to the moving averages on this chart here. All right. So what does up to, let's say if we start over here and we just look right over here to the edge of this title here, come right here and just look at from the laser pointer to the left, we see 3 moving averages and we see the price action. Now those moving averages are moving up, so that's telling us that the trend is up. Okay, and as you can see, a lot of times, see how we came back down and we tested these moving averages, and you'll have little breaks. It's not going to be exact on a lot of this stuff, but we come down and we tested this 50 moving average right here, and it held. It held that area of support, and it bounced off of it and resumed its uptrend. All right, so we have a bullish scenario here. Okay, the price is going up. We could put on a bullish trade if we planned it out correctly. All right, so what do we see here? We've already studied over some candlestick patterns, right? So you should know what candle formation that is. And we come down here, boom, we break the 20. We're trying to hold it. We open up the next day and we retest that 20, but we cannot break it. So boom, we fall down, we break the 50, okay? And then what do? The next day we come back up and we pretty much give the 50 a test, and we can't break it, and the price gets pushed all the way back here. So where is our next logical place? If you're using moving averages, what's the next logical place that you think that the price action is going to go? Probably down here to the 200. And look what happened. We came right to the 200 moving average, and we almost, I don't know, we would have to, I don't know if you would really call that a bullish engulfing, since the open and close right there are so much alike, but that's a pretty bullish candle. All right, so you held that as support, okay, and the trend was still intact somewhat, but you can see how the price action will react whenever it gets around these moving averages, okay? And look over here to the right here. Now you could probably say that we come all the way down here, and look, we tested this support area 3 times. We're below all 3 of our moving averages. We tested this support area 3 different times, like I said, and then boom, we took off, okay? We took off, we broke the 20 and the 50, we came up here to this area of support and resistance, right? See all this price action right in here? And we started consolidating. Now, what are we doing here? The price is consolidating, but you can see that it's nearing the 20 simple moving average. So if I was a betting man, I could probably say, hey, we're going to consolidate over this 20, and then we can resume the current trend, which is this trend right here. And we will bounce up and we will test this 200 simple moving average. And as a matter of fact, I don't have the slides to show, but I actually traded this move, and it did in fact bounce off the 20, and it went right up here to this 33.90 area and got rejected right there at resistance, right off of the 200. So you can definitely make some good trades with utilizing moving averages. Okay, A lot of times, with all trading indicators, the price won't always respect the moving averages. So nothing's ever 100%. You need to keep that in mind when you're trading off any indicators or candle formations. I know that I said it in the candlestick class, and I'm going to say it again, and I'll probably end up saying it a couple more times, but um, nothing is ever 100%. And, the market is a beast of its own, and it's a living, breathing creature that you can't always depend on to act rationally. I'll say that. Um, you will often hear of a thing called the Golden Cross. And I have a example here. And what it is, the Golden Cross is when the 50 and the 200 moving average, typically, is what the time periods that they use, they converge with the 50 being below the 200, and then they cross. Okay? And this is taken as a bullish sign for the price action. All right? And you can see it. The 50, here we are. The 50 is below the 200. Okay? Which is not good. But what happens? The 50 starts catching up, Price action is consolidating. We're getting the little pops here. Price action comes up and the moving averages cross here. That's a bullish sign, like I said, okay? Now, there's something also called the death cross. And it is the opposite of a golden cross. So that's when the 50 is above the 200 and they cross, giving us this scenario right here with the 200 above the 50. Okay, I think that is pretty simple to understand, and I think that it's worth talking about a couple different strategies that you can use with utilizing just moving averages and a little bit of support and resistance. I'm not sure if there's any official or formal names for these types of strategies, but I typically just call them breakout and breakdown. Okay, we can speak about the breakout strategy first. So here you're going to see a little snippet of a chart, and this chart is once again the S&P 500. Each one of these candlesticks are 15 minutes worth of price action. The light blue dotted line is the 20 SMA and the dark blue dashed line is the 50 SMA. I do not have the 200 showing on this chart. When we think of the word breakout, what's the best way to define or describe that? In my opinion, if you relate it to trading, I would probably say that the best way would be the definition of moving out of a range or an area. Okay, so on the left side of this picture, over here, what is it that we see? Okay, we see the price action starting out down here. It's below the moving averages. Okay, so we must have had a recent downtrend or something, right, for it to break below. And we see that the 50 is actually above the 20. So both of those things that we are seeing are theoretically bearish signs, right? But what happens next in this chart? The price action breaks above both moving averages. Right here, you see it break above both of them. Okay? And then it comes back to retest them right here. All right? So we have our break, we come back, and we're going to retest them. And hopefully, if we're going to start a new uptrend, we're going to use that as support. So on the retest, we see a significant bounce, and we see that the 20 SMA crosses back above the 50 SMA. Right there's your buy signal. Okay? That's whenever you want to go long. And whatever strategy you want to use to do, you go long, because right now, when we had that moving average cross with the price action breakout, we're going to view that as bullish, and we're going to ride the wave up. Okay? So we now understand a simple way of entering trades, right? So what about exiting trades? How are we going to use the moving averages to exit trades on a breakout strategy? That's very important because you always want to secure your profit, right? You don't want to turn winners into losers, okay? So if we're looking at the moving averages and we're going to use them for our exit strategy, then what is the first sign of a trend change after our entry? Okay, well, the first sign of the trend change would probably be whenever this 20 SMA starts to flatten out a little bit and we come back and we test it. Okay? That could be, you need to be on your toes at that point. I wouldn't necessarily close the trade with that, but it's definitely important to understand that, you know, a trend reversal could be imminent. Okay, so the better way to secure your profit would be a close below that moving average. Boom, there it is right there. That's where we would secure our profit. Okay, and that could show you that the strength of the bulls is falling off a little bit and we could get some downward movement. Okay, and I would close the trade, like I said, whenever we had a candle close below the 20 SMA. And if you took that exact trade right there and you entered it on the breakout that we talked about, then you closed it on that 20 SMA break, then you would have been in that trade for, oh gosh, around 90 points roughly. And if you're not familiar with, you know, trading the S&P 500 ticker SPX, I mean, 90-point move, that's a good move to catch. I mean, you can make some decent money on that move, okay? So I think that's a good example of a breakout strategy. I think that we covered it pretty well. Now, what about the breakdown strategy? What are we going to do for the breakdown? How can we utilize that strategy for trading? You'll see the same format of the chart before here. Okay. And everything still stands the same. There are 15-minute candles. The moving averages are the same, and it's the S&P 500. When we think of breaking down, then hopefully weakness comes to mind, and we can say that the breakdown strategy, we could say that the underlying is showing weakness and should start a downward trend, right? And we can use the moving averages as a type of support, and when they're broken, then that could be our signal. So it's kind of the same as whenever we exited our breakout trade, right? So look at the chart. The red arrow right here, it shows the price action broke below both the 20 and the 50, and it closed below it. Now, right here, yes, we had a break below both and a close below both, but that is not a good candle to enter a short trade on, okay? And you should know why. All right. This would be the more appropriate entry for a short strategy. We also see how the 20 is coming down to meet the 50, and it looks like they're about to cross. That's weakness. Okay, so at the red arrow there, we could open up a trade to the downside at this point and catch some momentum. All right, but where will we close? How do we know when to get out and secure a profit? And a lot of that will depend on what you want out of the trade. It'll depend on your how much risk you're willing to take on. Okay, it'll be different for every trader, but if you're going to use specifically moving averages and take all emotion out of it and just use those MAs, then two very easy exit points could be a close above the 20, or you can allow the price action to retrace a little bit more, give the trade a little bit more room to breathe, and let it retrace to the 50 and close upon a break of the 50 to the upside. Both scenarios are placed on the chart, and that's with the green arrows. Okay. Each scenario would have been they would have produced a pretty nice profit if taken at the entry point that we described. And in my opinion, neither exit would really be considered wrong. And always remember that it is never wrong to take profit, okay? Never wrong. It don't matter. I don't care if you took profit right here on this break of the 20 and then this happens and it falls another 50 points. I don't care. You had a successful trade, you followed your trade plan, and you secured that profit. That's what matters. There will always be another trade. You could have still been monitoring this, and upon the next break of the 20, you could have entered in another trade. Okay? And you could have rode that trade down until you seen this candle right here. And you could have been like, okay, we're using the knowledge that we gained from the candlesticks class. You could have been like, maybe there's a trend change coming. I can secure profit today, and we'll see what happens. You could have done that, and you would have had some successful trades. Okay? You just had to be patient. So in this lesson, we covered what a moving average is. We covered the golden cross. We covered the death cross and a couple different pretty good strategies that are centered around moving averages. I hope that you've been able to learn anything, learn a little something, and have found it useful. I hope that you can utilize it in your trading to help make some good profitable trades. As always, please, if you have any questions at all, I don't care if you are a part of our service or not a part of our service, it doesn't matter. If you have any questions, then please don't hesitate to reach out to me and ask, because that's what I'm here for. I want to help. I want to do that. So again, thank you for taking the time and viewing this video, and I hope that it helped out. And if you need anything, just let me know. Thank you.